Hello and welcome. India's markets are on a high, commanding a premium over peers, with mid and small caps still drawing heavy flows and infrastructure and renewables in sharp focus. To cut through the noise, I'm joined by Ajay Argal. He's Senior VP and Portfolio Manager at Franklin Templeton, known for his GARP style and QSGV lens. So we'll talk about valuations, his fund strategies, and where he sees the next big opportunities. Welcome, sir.
Thank you. Thanks for having me here.
Great to have you here. Now, to begin with the big picture, India has enjoyed a valuation premium over other emerging markets for a while now. With global uncertainties still high and valuation stretched, do you think this premium is still justified?
Yeah, so if you see historically, India has always got a premium to the emerging markets, and there have been very solid reasons for that. If we can just kind of simplify, there are a couple of main reasons. So one is the growth being higher than most of the other emerging markets over a long period of time. And within this long period of time, there will be some phases where it might look that we don't have that kind of growth. But when you look at long-term time frame, 3 years, 5 years, 10 years, 15 years, even the last 25 years, our growth has been consistently higher. And even now, if you look at the various economics projections in terms of the GDP growth, which will then flow into the top line growth for the companies, that still remains higher compared to the other economies in the world. As we all know, there has been a global slowdown. So the growth for all the companies and the world GDP growth and the GDP growth for all the countries have come down, and India has also come down, but India still remains the fastest growing large economies in the world, and therefore that will reflect into the faster growth for the top line of the company. So that was one reason, and we don't see that reason being changed anytime soon. Maybe at least over the next 5 years, or maybe even 10 years. The other reason was the return on equity. And the return on equity in the Indian corporate sector, the listed sector, has been always higher than the ROE for most of the emerging markets and even of course, the developed markets, because there the cost of capital is also lower. In India, the cost of capital has been higher. It is still high, but though it has come down. But more importantly, the ROE has been high because the founders, the companies have all been very focused on the return ratios, and that again is being driven because we have capital deficiency. The capital is not very easily available, and the capital market in India is now developed in the last 4 or 5 years. But before that, the capital market was also not so developed, so not easy to raise money. Before that, and even now, the bond markets are not very deep. And earlier, when India was not such a strong footing in terms of the macros, getting money from outside India always had a bit of risk involved. And when you included the forex hedging cost, then the cost of capital was not so low. So that's the reason the ROE has always been high. And for those reasons, we have got a premium. And typically, it has been, if you look at the last 10 years, the average premium has been around 60-70% in terms of if you just look at the ballpark PE multiple of basically India compared to the emerging markets. And at periods, we have traded above 100, 110, 120 also. And that is what was the case if you go last year. Now we have come down, but we have come down to the average premium. So we still are at a premium, you're right, but the premium is, in our opinion, now not exorbitant. And therefore, from a relative perspective, we are definitely better off what we were compared to last year when the valuations were a bit higher.
Sir, last year when we met, you highlighted how the mid and the small caps were trading at extreme premiums to the Nifty. Even after some corrections, the flows have continued to remain strong in both the segment. Do you feel the fundamentals have caught up now, or should the investor be cautious in the small and the mid cap?
Yeah, so it's a bit of both. As you rightly highlighted, there has been correction, and also there has been growth, and especially the mid caps, and more specifically the mid caps which form the part of the mid-cap index as defined by a regulator, those companies have actually shown much decent growth. Their growth has been higher than the large caps, at least as far as the profit growth is concerned, and especially in the last 12 years, 12 months rather, since the market peaked last September. So in that sense, there has been the valuation improvement. But at the same time, there is still a premium by the mid caps to the extent of maybe 30-35% to the large cap. And when I talk about this 30-35%, I'm comparing the mid cap index to the Nifty index. And if you look at the small caps, the situation is a bit different, because the small caps actually have had worse growth than the large caps, and they have also corrected, but that because of the growth being not much different from the large caps, their valuation premium has stayed at about 10-15% to the large caps. And as I had highlighted when we met last, that they typically trade at a discount. So from that perspective, the small caps and the mid caps both still are a bit on the higher side on the valuation parameters. But it is kind of a bit balanced for the mid caps in terms of the growth. So it is always good to remain cautious when these kind of numbers are there, because historically these numbers have not sustained. So there is two ways it can correct: either there is an actual correction, or there is a time correction in terms of the growth being higher and the returns not being so high compared to the growth, which is what we have basically witnessed in the last 12 months. So we would still advise caution, and we are getting from our bottom-up investment process, which we had talked about, QGSV, we're getting more ideas from the large cap space compared to the mid and the small cap space even now.
You've often described your style as growth at a reasonable price, using the QSGV lens, as you call it: quality, growth, sustainability, and valuation. So, in today's market where liquidity is abundant, valuations look stretched, and domestic flows dominate, how are you applying this framework? If you can elaborate on that.
So this framework has been tried and tested since many years. This is the framework we have been following. Franklin has been following for 20-25 years. And it has seen various cycles. So it has worked through the various cycles. And even now, as you are highlighting, liquidity is high, and the valuations are also high as a result. If you break down QGSV, one of the part is sustainability. So we have to look at whether this kind of growth is sustainable. By sustainability, we mean whether the growth is only for 1 or 2 years, or it is for longer, 3 years, 5 years. So typically, when we look at and build the bottom-up models on a stock-specific basis, we are looking at longer time frames. We, of course, have even 15, 20, 30-year models, though, of course, we know that it is only as good as the assumptions, but you get a framework, you get some guidelines as to what kind of growth needs to come to achieve the current market price and justify the current market price. So we still apply the same framework. Valuations, as I had already talked about, and that is where the P in the GARP comes from, that we look at growth at the reasonable price. So that's kind of very important, because we have seen in the last few months that there has been not very encouraging growth from any of the sectors, and that is why there has been a lot of sector rotation. So it is not as if one particular sector, or there has been some kind of euphoria which has built up where the growth is on the higher side. So even in that perspective, if we get an anchor to some solid solid valuation parameter, which in our case is looking at these things, which is both qualitative and quantitative. Quantitative we talked about in terms of sustainability, valuation, even growth, and quality, as the Q suggests, we look at how the management track record is, how the industry is evolving, how the particular company is standing, what have they done in the past, have they achieved their numbers. Because in this kind of euphoria, the companies are not getting let's say, punished to the extent if they kind of disappoint, because there is too much of liquidity. But it is all a relative performance, and from that perspective, generally where you have all these other three parameters as well as the qualitative aspect fulfilling, you get a better chance. So we still stick to this framework of investing, and we are getting enough ideas, and we have seen that over the cycles this works out.
Now, sir, some fund specific thing. Both the value and the focus fund have a solid long-term track record, but have recently lagged in the performance in the last 1 year or so. Do you see this as a style cycle at play, or a signal to reassess some portfolio calls?
So it's everything. The signal to reassess the portfolio calls is a continuous process. We are anyway doing it, and as you rightly highlighted, in the short term, there has been some performance challenges, maybe on stock specific basis. But even otherwise, we are doing our attribution analysis on all the funds on a very regular basis, definitely every month, and sometimes even shorter than that. So we are totally aware of which stocks are doing well for us, which stocks are not doing well for us, and it gives us a kind of a dashboard to figure out if the stocks which are not doing well, what are we going to do with them. And it does not mean that we will definitely kind of get out of those stocks, but it gives us a reason to kind of re-evaluate them, whether we are making any mistakes or is there some new information which we have not built in. So that's a continuous process. That is the job which we do every day. So that is one signal which is definitely coming out of it. But as you yourself have highlighted, when you look at a longer time frame, we are in a fairly good shape. So if you look at the focus fund, for example, 3 year, 2 year, and even 1 year, we are basically around median. We would ideally like to be towards the upper half of the second quartile. Right now, we are not there. We acknowledge that. But if you look at the 5 year, we are in the first quartile. So that is our style, that we want to have a very sustainable performance, so that in the shorter term, we are also towards the upper half of the second quartile, and in the longer term, we want to do to be in the first quartile. So we are kind of doing that in the focus fund. In the value fund, you are absolutely right in terms of style. So the style has definitely kind of shown the result. And why I say this is because in the last 1 year or so, maybe 15 months, value stocks have not done well. And if you recall, the last time I had met, I had mentioned this, that at that point in time, value stocks and the growth stocks were actually trading at the same valuations. But as we know, the value stocks do not have the same kind of growth. So it was looking very challenging from that perspective. So even now, there has been some correction in these value stocks, but in some of the other cases, it is still not there. And especially if you look at in terms of the competitor performance, we actually run the value fund strictly on a value philosophy, whereas from whatever we observe of the competition, the value funds are being run just like any other diversified fund. So in our case, just for your recall, we follow a very strict valuation based approach. As I was mentioning, in the other funds, we are focused on growth, but in the value fund, we are focused on value. We start with valuation. So we look at the various valuation parameters like price to earnings, price to book, EV to EBITDA, price to sales, return on equity, dividend yield, and we take an average of that. And within that, whatever the companies are on the lower side in terms of valuation, we take that. And as you're aware, NSE 500 is our benchmark. So we look at all the 500 companies and some of the smaller companies even outside them. But that is the main universe. And of that, we choose low valuation stocks. But at the same time, we try to get those stocks which can give some growth. The growth will nowhere be near the growth stocks, but that should, at least there should be some growth. Otherwise, there is a chance we might fall into the value trap. So we want to avoid that. And we have stuck to that. And those kind of stocks have really not done well. So if you look at any value oriented index, they would have they would have underperformed the broad indices like NSE 500 by anywhere between 6 to 8% in the last 1 year. So there, the style has definitely had an impact on the fund performance in the value fund.
Right. So like you mentioned, value investing often faces phases of underperformance when growth dominates. So, what do you think can change the cycle back in favor of value?
So that depends on the relative performance of the value stocks in relation to all the other stocks, and the relative performance can change basically in two ways: in growth and in valuations. And of course, the growth, whether if it kind of slows down tremendously for all the other stocks, or growth kind of stabilizes for the value stocks, or on the other hand, the valuation for the value stocks correct a bit more, and they become more attractive. So whenever that happens, and it is very difficult to say whether it will be only in a certain time period, because some people have observed that value works only for, let's say, X number of years, and then maybe 2X number of years they don't work. But it is not that way. It depends on the market cycles, and every time the market may behave a bit differently. So the only way to figure that out is whether these growth versus valuation combination, how is it looking in these two buckets. And from that perspective, as I was saying, that it is slightly better than a year back, but it is still not as if the value stocks are really very, very attractive. So for example, if you go 3 years back, when the value stocks were really attractive and we had a big re-rating and some of that was thematic re-rating in terms of the public sector stocks getting re-rated, because by the very nature, when you run down this, or whether you look at any value indices, there will be 50-60% of the weightage in those indices, or any of the funds which follow this process, will be in the public sector stocks. So as we have seen in the last 1 year, the public sector stocks have not done anything great, and there will always be a few exceptions, but in general. Whereas if you go back 3 years and look at their performance till a year back, there was a huge amount of re-rating which happened. So all these nuances, whenever they play out, we will have a better time for the value stocks.
Now, sir, over the past decade, many deep value calls like PSU banks, metal, old economy sectors only turned around when the government or the regulatory interventions played out their roles. Does that mean the value style is in India is more policy driven than a business driven?
I mean, it's very difficult to separate the business from policy, right? Even in whatever we call as the private sector, the policies are always having an impact. So right now we have just seen the GST rationalization. It is a policy impact, policy impulse, whatever we want to call, and it is having an impact on all the stocks. So it is not that way. It is also in terms of whether the growth improves for those stocks, or sometimes the valuations become so attractive that the starting point is really good, and then the trigger comes. You very difficult to predict when the trigger will come or what the trigger would be. One of the triggers which you highlighted is the government action, but sometimes some other trigger might also come. But once the valuation is at a certain level, then you don't have much to lose. So in that sense, the upside versus downside ratio becomes favorable. So in those instances, then it's a good starting point.
Right. So moving on to your portfolio approach. So you run all your funds, be it focused, value, or dividend yield, with a noticeable large cap tilt. So what is the underlying rationale for maintaining this tilt across different strategies?
Yeah, so that's not by design, as I was mentioning. Because of the kind of growth versus valuation dynamics which is currently working from our bottom up style of investment process, we are getting more ideas into the large or more ideas from the large cap space. And it is not as if it is for this particular fund. So if you look at fund like a flexi cap fund, which is not run by me, it might be having similar kind of large cap weightages. So our investment process itself, which places a lot of emphasis on growth and sustainability, and also at the same time that all those things should come at a reasonable price. Those are throwing more ideas from the larger cap space, because the ideas are more attractive in that space at this particular point in time. But it doesn't mean that that will always be the case.
Right. So your funds, they typically they show reasonable concentration, with the top 10 holdings accounting for about 40 to 50% of the portfolio. So could
Yeah.
you walk us through your portfolio construction framework and how you balance conviction with diversification?
Yes. So, I mean, we will have to separate the focus fund from that, because that is the category, that is the definition. You cannot have more than 30 stocks. So that's the reason the concentration is there. But even otherwise, you're right. I run a concentrated portfolio, because I believe that if your decisions are right, the impact should be substantial. And if you're having I mean, just to give an example, if you have a 50 basis point weightage, and if your call is right, and let's say you get a 50% outperformance in that stock, then just adds 25 basis points to the portfolio. Does not really make a big difference. So that's the reason I run most of the portfolios as higher conviction portfolios. So Build India Fund, for example, would have generally lower than 40 number of stocks, and a value fund will be having generally less than 50 number of stocks. As you know, value fund is also a diversified fund, and NSE 500 is a benchmark, so there is a big universe available. But I don't want to spread myself too thin. So the objective is to get the best ideas in the particular portfolio, and at the same time have some punchy weights, so that the attribution, positive attribution when it comes, it really makes a difference. So that's the approach while constructing the portfolio. But depending on what the theme is and what the objective of the fund is, we will diversify it that way. So, for example, in the value fund, it is just run like any other fund, diversified fund in terms of the sector diversification. Whereas in the Build India Fund, because the theme is related to infrastructure, we will have infrastructure related themes. At the same time, it is a thematic fund, it's not a sector fund. And maybe we can discuss that when we talk about the Build India Fund.
Now, sir, coming to the infrastructure sector, the BSE Infrastructure Index has gone from being one of the best to one of the worst in the last 1 year. Do you think the decline is a valuation correction, or has there been a change in the trajectory of the industry?
So I don't think it's a change in the trajectory of the industry. You just have to keep in mind that BSE Infrastructure Index is just one of the indices. And of course, it is the benchmark index for our fund. But as you would see in this particular fund, we are quite different from the benchmark. And the reason being that we think that this benchmark is not representative of the entire infrastructure space. So just to give an example, NSE Infrastructure is another index which is there in the market, and it's publicly available. So there the performance difference with NSE 500 is not too much. If my memory serves me correctly, last 1 year, NSE Infrastructure Index would not be more than like 0.5% difference from the NSE 500. So BSE Infrastructure Index has basically some specific stocks and which have not done well. On to your related question, whether the valuations have been on the higher side, which we had agreed 1 year back that yes, the sector had done very well. So if you recall, even in our focus fund, till about 18 months back, we used to have 20% plus weightage, and then over the next 1 year or so from there, we had got down the weightage to as low as 8%, because we had thought that a lot of good news was already discounted in the stock prices. And of course, that is primarily the investable universe for the Build India Fund. and the infrastructure space. So to some extent, that correction was required and it has happened. But as I have been highlighting, the infrastructure space is an evergreen theme in India. Over the last, I think our fund has been running for more than 17 years now. It has consistently done better than most of the diversified funds as well. And even if you look at the infrastructure as a space, any of these two indices, if you see, these indices itself has done better than NSE 500. That is the broad market. And the reason being that India has been infrastructure deficit country, and therefore there has been always a lot of potential in terms of investments. And when those kind of investments have happened from the government as well as the private sector, that has thrown up a lot of stock specific opportunities. And we believe that is the case even over the next 5, 10, 15 years, because that is something we will need to keep on doing just to strengthen our manufacturing. And as we have seen, this government has been focused on manufacturing, and it has come even more into the focus after the trade disputes which have been going on. So we think that the infrastructure investments will continue. Of course, there will be phases, just like right now. We are seeing that over the last 3, 4, 5 years, there has been huge public sector investments, and that has kind of been put on a hold, because right now the government is realizing that consumption also requires the support, and that is why we have seen the kind of policies like the income tax cut and then the GST rationalization. And over next year, we will also see the finance pay commission. So all that will be a consumption boost, and that is required, because only when that happens, we will see the private sector CapEx coming in. And that is the next leg of the cycle in terms of private sector, because the infrastructure investments has to come both from the public and the private side. So the public has happened and the private needs to happen, and before that the consumption needs to pick up. So it is that cycle which is getting played out, and therefore we have seen the lull in the last 1 year. But going forward, we remain confident that this will be a good investment theme over a long period of time.
But sir, the last big infra boom in the mid 2000s, it ended badly for investors. So what makes today's environment different?
Yeah, it's a bit different because there was a lot of euphoria during that time. If you recall, there were a lot of companies with hardly any revenue model. I mean, forget the entire business model in terms of having a profitability path. If you look at how the banks had kind of lent to those sectors, it was quite indiscriminate and at a very fast pace, and the accidents were bound to happen. On the other hand, this time, if you look, as I was highlighting, there has been hardly any private sector capex, and even the public sector capex has not been indiscriminate. It has been very choosy, and public sector anyway is kind of backed by the government balance sheet. So there is, and also the banking sector, if you see, there has been no extraordinary credit growth, especially in the infrastructure area. So all those typical signs of having some bad projects are not there. There will always be a few cases, but we don't think it would be a systemic risk this time. Also, if you see, a lot of players had got shaken out when that last cycle, as you were highlighting, happened. And now the players which are surviving are having much better balance sheet. And even those, they are continuously focused on having a very good debt to equity ratio, the debt serviceability, and they are very focused on improving the return ratios, ROCs. So they are being very choosy in selecting the projects, and that is why we are seeing that the private sector capex has not really been extraordinary growth. So to that extent, the accompanying problem of a very fast growth of all these bad investments is less likely to happen this time.
Now, sir, with InvITs, REITs, and new financing structures emerging, do you think the infra developer are now better positioned to unlock value and reduce the balance sheet stress?
Yeah, that's what we have already seen in this cycle, and you've rightly highlighted that. And also, you need to see that over the last, let's say, 3, 4, 5 years, the capital availability has also been good in the equity markets. And apart from the REITs and InvITs, the capital availability in the private equity markets and so many sovereign wealth funds looking to invest into the infrastructure space, even through the SPV vehicles. And of course, they do more thorough and rigorous due diligence. To that extent, the projects also chosen are much better, and therefore the sustainability and therefore the possibility of financing more and more projects going forward without having any accidents in between has improved. So all that has really helped in terms of the the right projects being chosen. And of course, there can be more infrastructure expenditure if the demand picks up. And as we all know, there is a demand issue right now. We have seen a slowdown in GDP growth, and the expectations for GDP is also slower for this financial year. And if all these measures which the government has taken, if this helps and improves the demand growth and therefore the GDP growth, then we'll see more and more of CapEx coming even from the private sector side. So it's a very good setup for the infrastructure space.
Right. Infra and power companies, they historically struggled with leverage and poor returns on capital. Now, do you see a genuine cultural shift in how managements are deploying capital, or is there still a risk investors must guard against?
No, investors must always guard against the risk. So there is no doubt on that. It's just that the companies and even the bankers have learned from their mistakes, and they've been more cautious. And of course, the global scenario has also changed. Last time around, there were more equity investors into this kind of space because there more liquidity was available in the equity space. Right now, it is more in the, as I was saying, private equity, sovereign wealth fund, or the those kind of spaces where the due diligence is much more rigorous, and also they've had more first-hand experience of similar projects and the challenges which they face across the world, not only in India. So that has been a good method of imposing the discipline, and that is why we have seen that the discipline is better this time round. But as an investor, one should always be wary of the risk, and especially the infrastructure related, you will have long gestation projects, and the problems actually become evident only over a longer time frame compared to the similar problems which might be evident in other sectors at an earlier time. So all those risks definitely remain, but it is reduced to some extent compared to the previous cycle.
Now, sir, renewables are scaling fast, but the issues are around storage, grid stability, and policy support remain. Which renewable business model looks genuinely investable today, and which are more hype than a substance?
Yeah, so all the models are actually under our radar, but right now we don't have the confidence of taking very large positions or very sustainable positions. So we are also trying to play a bit tactically in this space and continuously observing and trying to figure out which models are working. Of course, as you rightly highlight, that there is a lot of policy support needed at this point in time, and it remains to be seen when this policy support is removed whether the feasibility is there. And at the same time, the cost structures are also coming down. For example, in batteries itself, the costs have come down so significantly, both because of technology as well as the raw material prices coming down. Because renewable energy is a kind of new space all around the world, and therefore the moving parts are much more. It is not only what is happening in the domestic market, but also what is happening not only in China but other parts of the world. So we are still in the kind of observation and learning phase as to which models might work. It is clear that we should be closely tracking this, but whether we have the confidence that some particular space the models are very established and gives us the confidence, I'm not so sure about that. But as I said, we are still participating with a risk mitigated approach in terms of being tactical, in terms of having lower weightages, in terms of being taking a bit shorter term calls, booking profits whenever the opportunities arise, and so on.
Infra companies, they often boast of large order books, but execution quality and margins, they tell a different story. So what is your framework for telling apart companies that deliver quality growth versus those that just that are just chasing scale?
Yeah, so definitely the focus is there on observing the execution, and that is both in terms of not only the top line but also profitability, because in some of these cases the top line can be kind of generated, but you may not have the ample profitability, and if you don't get the profitability, and some of these actually the working capital is also very important because these are long gestation things. So we look at more on a project specific basis and how the return ratios are evolving in that. So it's a mix of both, because the order book is the lead indicator, but it is only a lead indicator. It's not a kind of given that if you have a good order book that you will be successful. How good you execute, and here the execution project management capabilities are very, very important, and we are keeping a very close tab on that in trying to identifying the companies which continue to do well, as opposed to the companies which may not be. And also there are nuances there. There are some product companies within that space where it is much clearer whether those things are working out. And some companies, or in some spaces, it's a shorter cycle, and in some spaces it is longer cycle. So all those nuances you will have to build in while understanding a particular company.
Now, sir, if you look at the infra sector, it's a quite broad sector, including roads, ports, railways, renewable transmission, and digital infra. So, according to you, sir, which is the most subsector do you find most compelling for the next 5 to 10 years?
Actually, it is all because everything is kind of connected. So it is not as if we can just do, let's say, roads and railways, and we can ignore the other subsectors like digitization or ports, for example, or metro, or kind of smart cities. So everything is connected, and everything has its own different cycle. You just need to figure out that at a particular point in time, what is what is having a better growth and a better execution at a profitable level, and try to kind of get into those kind of subsectors from, let's say, 18 months to 36 months perspective, because you need to remember that all these are also cyclical businesses. So we really can't evaluate them as very secular growth. Let's say, like we evaluate consumer staples or a consumer discretionary or a pharmaceutical kind of businesses. So these are cyclical businesses, and therefore you need to see it from that lens. But it's just that we kind of try to take a bit longer view compared to what is already discounted in the market.
Right. So one last question. Infrastructure stocks, they often look optically cheap, but what valuation framework do you use for infra companies, and how is it different from evaluating other sectors?
Yeah, so some of it I already mentioned in my previous answer. So basically, you have to treat them differently from the other sectors. So you have to just treat them like any other cyclical sectors. And for cyclical sectors, you need to be quite focused on where the cycle is. And as I mentioned, some of the subsectors are shorter cycles, some are longer cycles, some are products, some are services. And also you cannot have a kind of a, let's say, 5 year, 7 year kind of view, because there are so many moving parts in between. Obviously, there are policy changes. There is different thrust by the government. So as we saw last year, we think that that was required, the shift towards consumption. And whenever that happens, obviously, government, which is a big customer for some of the infrastructure related expenditure, that slowed down a bit, that will obviously have an impact. So even though I mentioned, like for example, India is a infrastructure deficient country, and the infrastructure space will be very good and very a lot of investable or opportunities will come over a very long period of time, maybe 5 years, 10 years, 15 years. But there will always be cycles in between where there might be they might be on the back burner for a bit. So we need to build that when we are constructing a portfolio, and that is the beauty of a fund like Build India, that it's not a sector fund, it's a thematic fund. So there are various sectors which are all related to infrastructure or make in India or manufacture in India, but they have kind of different cycles. So we have, apart from capital goods, we have industrial products, we have cement, we have metals, we have utilities, we have telecom. So many infrastructure spaces where we can kind of shift our weightages within that, so that we are able to give a better better risk adjusted return to the investors.
Right. So that was our long list of questions. Thank you for answering each one of them. Thank you for sparing time.
Thank you.